The IRS has made significant changes with the One Big Beautiful Bill Act, or OBBBA. It permanently locks in lower tax brackets and introduces 4 brand new deductions. We will cover everything you need to know about the 2026 tax law updates. The Tax Cuts and Jobs Act was set to expire, which would have increased tax brackets. However, the OBBBA permanently locked in the current 7 federal tax brackets, which are shown on this slide. The IRS inflation adjustments raised bracket thresholds by approximately 2.7% for 2026. This slide gives you a quick look at the updated 2026 tax brackets for single filers and those married filing jointly. The standard deductions for 2026 are higher, shielding a larger portion of your income from federal tax before considering write-offs. This applies to single filers, married filing jointly, and head of household. The first of the big 4 deductions covers tips and overtime. Service industry workers can deduct up to $25,000 in qualified cash tips. Hourly workers can also claim a deduction on overtime pay, capped at $12,500 for single filers and $25,000 for joint filers. Income phase-outs apply to both. The second deduction is a massive bonus for seniors aged 65 or older. It includes a standard age-based increase and a new standalone senior deduction. For married couples, if both spouses are 65 or older, that's a $12,000 bonus write-off. Note that this phases out above certain income levels. The third deduction is for American-made auto loan interest. For the first time in decades, you can deduct up to $10,000 of interest paid on a personal vehicle loan, as long as the vehicle's final assembly is in the United States. Income phase-outs also apply here. The fourth major deduction provides SALT relief for high-tax states. The old cap was $10,000, but the new 2026 cap is $40,400 for most filers. This significant change completely alters the calculation for itemizing versus taking the standard deduction. The child tax credit is updated to a maximum of $2,200 per qualifying child. There are also changes to retirement contributions. The deferral limit for 401k plans is now $24,500, with higher catch-up contributions for those aged 50 and over. IRA contribution limits are also increasing. This chart gives you a snapshot of the big 4 deductions, showing whether they have a more or less restrictive limit and a higher or lower phase-out threshold. Knowing where you fall on the income phase-out determines how much you can claim. Deciding whether to itemize or take the standard deduction now involves new factors. Consider if you own a home in a high-tax state, and if your SALT and mortgage interest exceed the standard deduction. The new $40,400 SALT cap makes itemizing viable for many more filers. We recommend running the numbers both ways. The tax strategies that worked 2 years ago are now outdated. Waiting until April to look at these numbers means you might overpay the government. Lock in lower permanent brackets, utilize the big 4 deductions, and benefit from the increased SALT relief. Plan now and review your withholding before year-end.